Hello, my name is James Kim, and I'm a partner in the Governance Strategies Practice Group in the DC office of McDermott, Will & Emery, as well as the lead of the firm's Paycheck Protection Program Loan Assistance Task Force. Thank you for joining us today on this Thursday afternoon. The PPP loan program has been one of the most rapid distributions of financial assistance by the federal government in this nation's history, with over 5 million loans approved at a value of over $525 billion, promulgation of more than 20 interim rules, and issuance of multiple frequently asked questions and other forms of guidance in the last 6 months alone. The team here at McDermott has over a decade of experience working directly with the Small Business Administration, including high-profile suspension, debarment, defense, litigation, and appeals of SBA determinations. And we hope to bring that knowledge and experience to bear for our clients throughout the PPP loan program. Our webinars to date have covered the PPP loan application, following the program's establishment in April, the government's guidance on forgiveness in May, and today's goal is to summarize the most recent changes and significant ones to the PPP loan program, and particularly the forgiveness process since part 1 of our webinar 3 months ago. For this purpose, as shown on this slide here, we have assembled a panel of subject matter experts that include our colleague, Andy Gibson, who is the leader of BDO's Global Employer Services Practice and is also the managing partner of BDO's National Tax Office Advisory Technical Leaders. Andy will be providing a view of PPP loans, particularly from the lender's perspective. We have Llewellyn Engel, an associate in McDermott's DC office, who is a part of our Government Strategies Practice Group. She's going to be discussing the nuts and bolts of forgiveness and providing some examples on how the SBA forgiveness requirements may affect your organization in particular. Mr. Sam Neal, an associate in our McDermott's DC office, who is also a part of our Governance Strategies Practice Group. He will be discussing SBA audits of PPP loans, considerations related to M&A, as well as a brief legislative update. Finally, we have Andrew Liazos, a partner in McDermott's Boston office and the head of McDermott's Executive Compensation Group. He's going to be providing some insights related to tax considerations, as well as some developments regarding the PPP loan insurance product that's now available on the market. Thank you again for everyone for joining this afternoon. Move to the next slide, please. We have here a listing of the agenda. We're going to leave open a few minutes at the end of the presentation to address some of the questions that have been submitted previously, but we request that you send the questions in to us in the information listed here. We'll try to address them when we're able to, but we can't promise that we'll have an opportunity on today's webinar because the amount and breadth of information we'll be providing today. Thanks again for joining. I'm going to turn it over to Ms. Engel to start discussing with regard to the forgiveness overview. I'm sorry, Mr. Gibson first to talk about then to Ms. Engel. My apologies.
No problem. Welcome and thanks for joining us this afternoon, and glad to take a few minutes to give some thoughts. We at BDO, we have about 3,000 plus borrower clients out there that we've been working with since day one. When they started getting loans, because obviously the forgiveness part is a crucial part of the entire process. But we're also working on the lender side with a number of banks, and have also spoken with a number of banks about the process, about how they're going to handle stuff. And we actually had one of our banks go live today with their portal and are in there accepting applications, and I've already had a number of borrowers already submit their forgiveness applications, so we're already on that task going forward. So what we've done in this slide is I put together just a lot of the stuff we're telling our lender relationship managers, really those that are right in front of the borrowers directly as clients, and the things that they need to be ready to focus on, and also what their borrower clients are going through, many of whom are on the call here. So we've just highlighted the items, and I'll just chat about these a little bit, and then the rest of the presentation we'll talk in more detail on some of the things that I'll mention. So there is potential legislation out there. Senator Rubio, along with another senator, has put together a proposal that would make significantly simpler changes, in particular for loans below 150,000. So we're telling the relationship manager, you really got to watch out for that, and that'll be discussed in terms of what that legislation looks like later on here today. So I'll save that for later. What I would say that in all the banks we've talked to, which has been many, in addition to the ones we're directly working with, those that, generally speaking, those that did about 1,000 plus PPP loans at the bank and more, are going down the portal process of automating the entire process, which is building a portal for the borrowers to go in and fill in the actual form online and submit the appropriate documentation. And primarily, they are doing it that way. I think they had a pretty rough go with their internal staff on the application side of just manually doing, a lot of applications. And on the back side here, most of the banks that I described, all but one that I know of, is getting the portal set up, and then the borrowers going in and virtually filling out the form. There's worksheets in there, and the one that we have, where they can actually do all the worksheets in there as well, and then attaching the appropriate documentation. And then the bank, and in our case, many of the banks will actually do the reviews of those. So, but it's in that process, the things that they need to be focused on is, one, they need to get a list of all their borrower clients. Now, most of them already have that in a data format. So fortunately, that's just dropped right into electronically into the portal. It pre-populates the loan number, the SBA number, et cetera, the amount of the loan, and that kind of thing. So a lot of that should be, for those of you that are working with banks that are going to have a portal, a lot of that stuff is already pre-populated in there for you. So that should be pretty useful. What I think the lender relationship managers are going to do is, and certainly on the portal that we have, in addition to listing all the individual loans out and what's been submitted and where does it stand in the process, whether it's just been submitted, there's been an initial review, or there's been a review but sent back to the borrower to submit additional information or clarify some things. They'll also have a dashboard that allows them to keep track of where the things are in the process, what are some of the key issues, like as will be discussed later, loans that are $2 million or more, in theory, going to get audited. So in some of the dashboards that we built for lenders, it lists the ones like by company or by business that are $2 million or more, so they know to pay a little bit more attention to those in terms of documents that are submitted and those kind of things. So I think for you, those of you that have that large of a PPP loan, you can expect some of that closer watch on the lender side. We've also been doing some training for the relationship managers around not so much making them technical experts around the rules per se, but coming to a position of, here's what the borrowers need to know in terms of elections they need to make and considerations they need to make of whether they can use the Form EZ or the safe harbors, a lot of which will be discussed by Llewellyn here in a few minutes. But also, what are the issues that they're out there? And we've put together just a list of all the kind of gray areas out there in terms of, as a utility, what are the various things there? And there's some other issues around retirement plan contributions of what qualifies during that time period. There's not a ton of guidance by the SBA on those. So, basically the lenders are taking a look at these gray areas so that they know what positions they may want to take when the borrowers submit their information. So provide them with that. So they should be, pretty well aware of what those potential issues are. We've also coached them on, the sophistication of borrower clients. Not so much knowledge about PPP loans, but who's helping them, maybe. The smaller loans probably have less opportunity to obtain help from a CPA firm or a law firm like ours and McDermott. And so the bigger ones, we're helping most of our clients. So helping them do a preliminary look at what their payroll costs are and the rent, utilities, and the analysis. And so we're helping a lot of them out. Maybe, on the smaller loans, they might not have that level of help. and the relationship managers are going to be paying attention to that. And then what type of business, for those that are borrowers on the webcast, what type of business are you? A corporation, a partnership, sole proprietor? Because the rules can be slightly different, especially in who the owner is and the comp that's counted and those kind of things. So, and we can already see that coming through on the ones, on the submissions that have already been made. And then, we have a lot of PPP technical resources at BDO, as does McDermott. So we provided that to our lender clients, but we also have that on our website. But also, the relationship managers also need to know where the SBA resources are, and that's basically treasury.com. And if you click in there, you can find 2 clicks later into the list of everything that's been issued by the SBA around the PPP loan program. So we think the relationship managers, if they follow these kind of guidelines, they'll be in a great position to assist their clients in getting this done, because we know that the borrowers want full loan forgiveness, the bank does probably as well, and we do as well. It just makes it easier to get these things done. So with that, I will pass it along.
Andy, I got a quick question for you.
Sure.
When you mentioned earlier that borrowers' information is pre-populated in a number of the lenders' portals or databases, do you know if the lenders have been populating the information of those borrowers' affiliate companies, or is it limited strictly to the borrower itself?
It is the borrower itself, although I think, and I haven't seen one on the affiliation submitted yet, but there is a link in there to be able to know that they're part of an affiliated group, and particularly because of the $2 million, right, loan, the audit requirements. So, great question.
Andy, one quick follow-up. I'm sure we'll be able to follow up afterward. But if people were interested in knowing where you could find those technical resources on your side, do you know where an easy location for that? We'll be happy to send around a link or something like that if that's helpful.
Yeah, BDO.com, and right out to the right of the screen, I can see it. There's a COVID-19 whole warehouse of stuff on the PPP, as well as the other, CARES Act, other CARES Act stuff. So, thank you.
Thank you. Next up, we have Llewellyn Engel from our DC office, who will be providing additional background on the forgiveness process and the PPP application itself. Llewellyn?
Yeah, thanks, James. So I'm going to be covering forgiveness in more detail, but as you just heard from Andy, he is also an expert in this area. So I'm going to be looking to him throughout for any additional insight he can provide as we go along. So on our next slide is a quick chart of where we are today. So what feels like forever ago back in March was when the CARES Act was enacted, and the program went live in early April. Somewhere between this additional $310 billion in funding and the June 5th Flexibility Act, we had our last webinar. So there's a lot to cover since we last did the webinar. Over this time, there's been 23 interim final rules and 77 FAQs, which really shows the amount of information out there. So we'll dive into some of the nuts and bolts of forgiveness. And on our next slide, we have just a quick overview. A lot of these changes do stem from the Flexibility Act that was passed back in June. Luckily, the act made it a lot easier for borrowers to spend the loan and then to apply for forgiveness. So we do have some good news since last we spoke. So I'm going to go through these changes and discuss how the changes impact borrowers as they begin the process of filling out the application and wrapping up the spending of the loan. So on our next slide is the first big change that was introduced by the Flexibility Act, which was that 24-week forgiveness period. This was great news for a lot of borrowers. This extended the original 8 weeks and just gave everyone a lot more flexibility in using the loan. It did, however, raise some questions. So on our next slide, we have some of the common questions that people have been asking because of this new 24-week period. So the first one is just, which one should you choose? If you did receive your loan prior to June 5th, you do have the option of which one you prefer to select. If you received it later, then you do automatically take advantage of the 24-week period. So by this point, I think if you had the 8 weeks, that time period is run, but I think it's a good option to go with a 24-week period if you had any issues spending the loan within the 8 weeks or spending 60% of the loan on payroll costs. So this is generally, for probably many borrowers, something that they'd want to look into. Of course, the next big question that we had was whether or not you had to wait for the full 24-week period to be up before you applied. There was definitely a lot of initial confusion on this, but luckily we got a 20th interim final rule from SBA that said, no, you don't need to wait. Borrowers that elect the 24-week period can go ahead and submit a forgiveness application once you've used up all the funds you seek to have forgiven. This doesn't mean that you don't still have a 24-week covered period, but it does mean that you're allowed to apply early within that period once you've used up the funds. This does, of course, raise some issues. So for one thing, SBA clarified that even if you apply early, if you end up with any reductions in salary and wages, you have to apply it over the entire 24-week period. So I'm going to discuss that in more detail later on when we're talking about salary and wage reductions. But just keep in mind that just because you apply after 12 weeks, you do still have to keep the 24-week period in mind for a lot of these scenarios. And of course, that raises another big question that I really do think is fairly outstanding is, what if a borrower uses the entire loan in 12 weeks, goes ahead and applies for forgiveness as is permitted, and then reduces FTE headcount after having already applied, but before the end of the 24-week period? There is nothing on the application that requires you to update the SBA if you later reduce headcount. There's no duty there. The application only is asking you for your headcount up to the time that you're applying. So there's nothing on the face of the application that suggests that would be a problem if you go ahead and reduce FTE headcount after you apply. However, there's definitely some risk there because especially those borrowers with larger loans, they're going to have an audit. So SBA could become aware of that reduction, or definitely would if you get audited. And so I think it's just something to keep in mind. We're still a little bit unsure about how the SBA is going to treat those FTE reductions. So those are some important questions to keep in mind throughout our discussion here. So up on our next slide is the second change, which is the reduction of the payroll cost requirement. So in the original CARES Act, you had to spend 75% of your loan on payroll costs. And a lot of borrowers were running into issues with that, especially those who had reduced the number of employees on payroll. So in keeping with the idea of having more flexibility, Congress lowered the requirement down to 60%. And that's just a minimum. You can, of course, spend more. The number of, or the types of expenses allowed didn't change. We had some questions about that that people had raised earlier. And the answer is no, there's not additional expenses. Those categories do remain the same. It's just the percentages did change. And then another point to just keep in mind that SBA clarified after the Flexibility Act is that this 60% requirement isn't just isolated to forgiveness. So there is a requirement that 60% of your forgiven amount has to be going to payroll. So if you don't meet the 60% threshold, then your forgiveness amount will be reduced. It won't be eliminated, but it's going to be proportionally reduced. However, you do still have to keep in mind that the 60% is also an overarching requirement of using the loan. So you will still need to make the 60% by December 31st if you are going to use it outside of the forgiveness period. So there was a lot of questions about that early, and then SBA cleared that up in a rule. And this is a lot of information, so we can look to the next slide and we'll run through an example. So say you receive a $100,000 loan. I like to have these nice round numbers. It makes it a lot easier to do percentages. And so say over the course of your forgiveness period, you only are able to spend $54,000 of your $100,000 on payroll costs. If you can do the math, this is only 54% of your loan going towards payroll. And so because you still haven't met that 60% requirement, the maximum amount that you're going to have eligible to have forgiven is $90,000. And so that will be, $54,000 in payroll costs, which is 60% of that total forgiven amount of $90,000. and $36,000 in non-payroll costs, which again is equal to 40% of your total forgiven amount. However, because you haven't yet met this 60% requirement, that extra money, that extra $10,000 that you're going to be spending outside of your forgiveness period still has to be used in a way that gets you to 60%. So you'll have to end up spending at least $6,000 of your remaining loan proceeds on payroll costs by December 31st. So basically the biggest thing to keep in mind is that if you're planning to spend all your loan proceeds during your forgiveness period, you should make sure you're spending at least 60% on payroll costs.
And Luella, just to clarify on this slide right here, that point, that what you're saying here is that for the last 6% here, you still need to spend it on payroll costs, but not on forgivable payroll costs.
Correct, exactly. So yeah, if you couldn't get there in your forgiveness period, you had that $10,000 that's now outside your forgiveness period. So unfortunately, you won't get forgiven, but you still have to get up to that 60%. So you don't get $10,000 to use however you want after the end of your forgiveness period. It's still an overarching requirement to keep in mind. So on the next slide, we're going to go on to another, change, I suppose we can call it, which is to allow more compensation to individual employees. This really actually just ties back to the extension of the 24-week forgiveness period. So this wasn't really a change, but it is just a result of that longer amount of time to spend the money. So in the original CARES Act, Congress defined payroll costs as only compensation up to an annualized $100,000 per employee, and said that you cannot use your loan to compensate employees beyond that $100,000 as prorated for the covered period. So how SBA originally treated that was to issue a rule saying in your 8-week forgiveness period, you can't spend more than just over $15,000. People were wondering if they were going to update the rule. They did. Now they're saying, okay, over 46 or over 24 weeks, you get just over $46,000 per employee. However, for any of those individuals out there who are owner employees or self-employed individuals or general partners, they didn't allow you to go all the way up to $46,000. Instead, if you're doing that 24-week forgiveness period, you're actually capped at just over $20,000. So they said they believed it would have been a windfall to allow self-employed individuals to go all the way up to 46. So for those of you in that situation, just keep that one in mind. On the next slide, we'll come up to kind of a question that arises because of this, and because so many people don't actually need to use the full 24-week period and end up going to apply early. People have been wondering, can they still spend $46,000 per employee? As I mentioned earlier, even if you're applying early, you still have a 24-week covered period. So the language is a little bit ambiguous, but I think the least risky approach would be to make sure you're prorating the $100,000 over the time which you're using the loan. So if you apply after 12 weeks, having used 12 weeks worth of payroll, I would just make sure that you prorated the $100,000 over those 12 weeks, which ends up meaning that you're able to spend about $23,000 per employee. So before we move on to sort of the FTE and salary and wage reduction calculations, I just thought we'd check back in with Andy to see if there was anything you wanted to point out or any clarifications you want to make.
Yeah, I think this is great, and I think you're about to head into an area that I think will helpful these in the sense that, you know, there are going to be these exceptions to rehiring people and all this kind of thing, but the bottom line is those are nice that you don't get penalized, except you got to spend the money to get the loan forgiveness. So, you know, that's where it gets challenging. Those businesses that have already spent the money and kept people in, and they're going to be able to apply right away and have spent the money by the 12-week or 16, whatever week period it is. Those that haven't been able to rehire, they get the break of the 24-week, but you're still going to have to end up spending money to get the loan forgiveness. So that is really important to keep in mind, I think.
Yeah, definitely. So I guess then we'll move on to the more exciting or maybe challenging part of it, which is the FTE and salary rate and wage reduction calculations. So in this next section, I'll go over what is that salary wage reduction calculation? What are some safe harbors that can be applied there? Also, what is the FTE reduction calculation? Several exemptions that you should keep in mind, as well as the safe harbor that lets you avoid reductions in forgiveness if you ended up reducing salary or FTE headcount. So first up is on the next slide, we'll do the salary and wage reduction calculation. What this does is says if you laid off employees or if you reduce employee salary and wages beyond 25% during your forgiveness period, as compared to a look back period, which is January 1st through March 31st, then your loan forgiveness amount will be reduced by the amount of reduction beyond 25%, unless you can take advantage of safe harbor. So the idea that Congress had was, they were giving this money to encourage people to pay employees. So if you ended up reducing employee salary, you're going to get penalized for any forgiveness amount. Keep in mind that this salary and wage reduction calculation only is going to be applying to those employees who didn't make during any individual pay period in 2019 more than $100,000 as prorated. So for example, if you had someone that was getting paid $4,000 a week, they don't count. You don't have to take them into consideration when doing these salary wage reduction calculations. And the thinking behind that was if you had, a high-level executive who all of a sudden during COVID says, I'm gonna cut my own pay to help the company, Congress didn't want to run into a situation where they were going to get penalized for doing that. So they wanted to give, certain individuals making more the flexibility to do that. So I think the easiest way to understand is just, again, running through an example. So if you had an employee from January 1st to March 31st of this year was making on average $1,000 per week, and then during your 24-week forgiveness period, that employee was only averaging $500 per week, clearly they've had a $500 per week reduction. The first $250 gets exempted because you're allowed to cut pay up to 25%. However, the other $250 is going to be deducted over each week from your total forgiveness. And so as I said, I think way back in one of the earlier slides, that you do still have to apply the salary wage reduction calculations over the full 24-week period, even if you apply after 12, this is where this comes into play. So you have to multiply the 250 times 24, which gets you to a reduction because of just that one employee of $6,000 to your forgiveness amount. So it basically is just saying you can't dodge the full ramifications of the salary reduction by applying before the end of 24 weeks. So that's just something to keep in mind when you're working through the math on this calculation. So on the next slide, if you do end up in a situation where you reduced employee and salary and wages, you can go ahead and take advantage of what's known as the salary wage reduction safe harbor. So this is only applying for those employees that reduced wages between February 15th and April 26th, and then go ahead and reverse those reductions anytime between really now and December 31st. The forgiveness application specifically says that the safe harbor is the earliest of December 31st or the date you apply. So what this really means for borrowers is that once you've reversed any reductions, you can go ahead and apply and then take advantage of that safe harbor. You do not have to wait until the end of the year in order to do so. So one question that's been coming up is whether or not you need to completely restore salary, or do you still get that 25% buffer? And if you look at the forgiveness application, unfortunately, it actually asks whether or not your salary and wages on the date of application is equal to or greater than the salary and wage on February 15th. So you don't get that 25% buffer. You do have to bring salary and wages all the way up. To be honest, I think the easiest way to really understand this is just to look at the application and work through maybe a simpler hypothetical, and you can kind of see how these different calculations kind of all come together. I think it was the way I was able to learn it the best, is to just run through an example on my own and actually kind of get into the weeds on some of the math here.
Yeah, hey, Llewellyn, on that point, our portal's built with a calculator. You can actually go in, the borrower can go in and run calculations on it and just save them and change them and all. So they're not locked in once they go. They can actually use that as a tool to do projections on. So.
Oh, that's great. Yeah, that's a great planning tool, because I know a lot of people are now sitting down trying to figure out, if I do X, like if I have to reduce salary, like what is that gonna, how's that gonna implement my forgiveness? Like when do I need to bring it back up? So I think that's a really great tool in order to sort of be able to do some of this planning, because I know a lot of people, they're trying to figure out how do we maximize it, but also still make the right business decisions. So I think that is really important. So on our next slide, we go into the slightly more complicated FTE reduction calculation. So for this one, there's actually a few different separate calculations you're going to need to do before you're able to figure out whether or not you need to take an FTE reduction. The first one is to determine the average number of FTEs you had per week during if you're a non-seasonal employer, one of two different periods, either February 15, 2019 to June 30th, 2019, or January 1st, 2020 to February 29th, 2020. And then if you do happen to be a seasonal employer, there's even a third period you're allowed to look at. So what you should do is calculate your average number of FTEs during either this 2019 period or this 2020 period, and then you take whichever one you have the least number of FTEs in. And by selecting the one with the lowest number of FTEs, you make it easier on yourself to meet that number in your forgiveness period. And then, so the next step will just be to determine the average number of FTEs per week during your forgiveness period. On our next slide, in a couple minutes, I'll discuss some of the exemptions that help you make that FTE number as high as possible during your forgiveness period. So there's a few different ways you can try to make this number a bit higher. So once you've determined the FTEs during your reference period and during your forgiveness period, you're going to divide the average number of FTEs in your forgiveness period by the average number of FTEs in the reference period. And so once you've done that division, if the resulting number is less than 1, it means that you will have an FTE reduction to your forgiveness amount unless you can take advantage of a safe harbor. So for example, you can do it, just run through the math on it. It has it in the application once you've kind of figured out what is your most favorable reference period. So on the next slide, we'll go over a few of the exemptions. So this is how you determine what your actual FTE headcount is during your forgiveness period. Essentially, these exemptions were just kind of common sense things that Congress put into place so as not to penalize borrowers who are just kind of conducting average everyday business. So the first one is you don't have to have an FTE reduction for a position in which you made a good faith written offer to rehire an individual who had been an employee, but then that employee refused and you couldn't fill the position. Although then Treasury said you do have to alert the state unemployment office. And so the idea with this is that because PPP was trying to encourage people to bring employees back and put them on payroll, they didn't want to penalize borrowers who tried to reach out to employees and just couldn't get people to come back. So that's the reason for that one. And then the second one is a kind of similar. You made a good faith offer to restore any reduction in hours. And the reason the reduction in hours is important is because we're talking about FTEs. It's not just individual employee headcounts. It's hours worked can be very important. So if they had gone down to half time, that could have made them a half FTE. That's why restoring salary and wages is important. And then the final category is that you don't have to take a hit for employees who are fired for cause, voluntarily resigned, or voluntarily received and requested a reduction in hours. So if you had a couple employees that left the company of their own reasons, like that's not going to end up penalizing you. However, you have to keep in mind that if you did fill someone for those vacant positions, you don't get a double count. And you do, of course, I keep telling everyone throughout, make sure you do have the documentation to support it. So on the next slide, we'll go over a few examples of how this works out, because I think running through the examples is probably the easiest way to really understand it. So say, for example, you have 100 FTEs on February 15th, and then the first person, Nancy, is going to be fired for reasons that are completely unrelated to COVID-19. As I touched on the last slide, if you're terminating someone for cause, that's not going to bring you down. So even though now you only actually maybe have 99 people working at your company, your FTE headcount for the forgiveness application is still going to be 100, because Nancy being fired is not going to penalize you. The second person, and so in late March, you cut Ben's hours by 50%. If Ben had been a 1 full FTE before that, and now he is down to only working half the amount of time and he becomes half an FTE, because this is a COVID-related cut in hours, you'll actually go down to about 99.5 people, or 99.5 FTEs. Then, for example, in early April, you go ahead and furlough Alex because of COVID-19. You're gonna, because it's COVID related, take another 1 person or 1 individual reduction in FTE. So now you're down to about 98.5 FTEs. Then in May, Mary quits the company. As we touched on the last slide, that's fine. You don't have to take another hit because Mary is now going off and doing her own thing. So now you're still at 98.5 FTEs. In June, you go back to Ben and say, oh, hey, Ben, you know, the company is doing better. We'd like to give you your full hours back at the same wage. But, you know, Ben is saying, actually, I don't like working half the amount of time. So because he's refused, you now get to go back up to 99 FTEs because you've now taken advantage of another exemption. Then in July, you go back to Alex and says, hey, Alex, do you want to come back? Like, sorry, we let you go, but we need you now. And Alex says no, you know, for who knows, whatever reason. And then so you do have to alert the state unemployment office if Alex has been taking unemployment, but because he's rejected your offer to come back, he is now no longer a penalty. So now you're all the way back up at 100 total FTEs. In July, you now are hiring someone to replace Mary, who had quit back in May. You don't get to go up to 101 FTEs because now Mary's leaving is being replaced. So now you're still back at 100, even though all these things happened, and even though you might have either less or more people working at your company. So this is just different ones to keep in mind and some of the examples to run through, but it kind of shows how your average FTEs will be subject to some change based on these exemptions. So that's the FTE one, which I guess is just a little bit more complicated than what the application might initially look like, but if you have been keeping track of all this, it should be pretty straightforward. So on the next slide, we'll talk about the safe harbors. So if you do end up with, you are not quite as lucky as our borrower in example, and you do have less FTEs, there are 2 different safe harbors that you can take advantage of. The first one, and this one was the one introduced by the Flexibility Act, and it's a great exemption, to be honest, and it's a pretty big, broad exemption for a lot of people. And it said that if you are a borrower whose business is not at the same level of business activity that you enjoyed back in February 15th, then you might be able to take advantage of this safe harbor. There's a lot of questions over what the same level of business activity means, and they didn't provide a definition, which is actually a good thing, I think. It doesn't say, you have to have suffered 20% reduction. It's just that during your forgiveness period, you're not at the same level of business activity that you had been, which kind of seems to indicate that even if you're just slightly reduced, then you could still be eligible for this. So to take advantage, your business did have to have been impacted due to compliance with guidance issued by HHS, CDC, or OSHA between March 1st and the end of this year. And that guidance had to relate to health and safety to prevent the spread of COVID-19 and different social distancing guidelines. So all that the SBA has required for you to show in order to meet this exemption is that you're able to certify in good faith and document that the reduction in business activity during the forgiveness period stemmed either directly or indirectly from compliance with COVID-19 guidance. This means that you do need to keep copies of any COVID-19 guidance that was applicable to your business, and they do say per business location. So if you're a restaurant with 5 different restaurants in 5 different states, and some of you followed even state guidance, just make sure you have copies of all that. And then you're able to show that you had some sort of reduction to your business because, customers had to be spaced 6 feet apart. But there's sort of a lot of outstanding questions about how flexible they're going to be in treating this. You know, we don't know, but sort of from how they've interpreted so far in the rules, it does seem that this is going to be a fairly broad exemption that a lot of people are going to be able to take advantage of. So on the next slide, this is an example, and this is straight from Treasury and SBA's guidance that it issued. It uses the example of a business that sells products both in store and online. And I think it's a really helpful exemption because it explains that even if your entire business wasn't impacted, you can still take advantage. So in this scenario, the online business was doing fine, but the in-store one wasn't. And Treasury is saying that you can still take advantage of the safe harbor because you're not at the same level of business activity over your 24-week period. So you should just look at the full 24-week period. And if you, so many businesses have been impacted by compliance with social distancing requirements, this could be a great exemption for you. And then if you can take advantage of it, you don't have to worry about the FTE headcount reduction at all. So Andy, is there any additional clarifications or insight you want to give before we go on to the second safe harbor?
Yeah, these are important, but it goes back to the comment earlier that these, you're probably going to have to use the 24 weeks because you still got to spend the money. So you don't have the reduction, but you still got to end up spending the money. So, but this is very important, this FTE stuff, no question.
Yeah, no, it definitely is. And then on our next slide is the other safe harbor, which this is the one that's been around since the CARES Act was passed. And I mean, it is just as important for maybe borrowers who don't have a reduction, but are still looking to reverse any FTE headcounts that they had early on. So, you know, maybe their businesses weren't impacted because of guidance, but they can still avoid an FTE reduction penalty if they're able to reverse any reductions in FTE headcount by December 31st. So just like with the safe harbor that applied to salary and wages, the reductions in headcount needed to have been between February 15th and April 26th. And the safe harbor is met once your total FTE headcount exceeds the headcount on February 15th. And so you do not have to wait until December 31st. You can go ahead and have the safe harbor date applied on the date you're forgiven. And just as I said before, I think one of the easiest ways to really understand this is to run through the steps that are laid out in the application and in the instructions, and it kind of helps you understand it a little bit more. And then obviously, as Andy said, it sounds like BDO has some great tools that will help you with your planning and let you experiment to see whether or not you need this. One question that has come up is whether or not this is an all or nothing thing, and it is. You do have to fully reverse headcount. You can't just bring it back up a little bit and then you don't get to like reduce the amount of forgiveness penalty that way. You do actually have to fully reverse reductions. So the next slide, that is the just a quick overview of this SBA Form 3508EZ. So this is for those individuals who were able to, take advantage of the safe harbors we talked about, or, ended up not having any wage reductions or any headcount reductions. This form was really in response to a lot of criticism that directed at Treasury and SBA that said that the forgiveness application was too long and way too complicated, in part because it is long and complicated. So this was Treasury and SBA's response by having a much shorter, simpler version for those borrowers who don't have quite as much of a complicated forgiveness process. You do, by and large, have to submit a lot of the same documentation, and you probably do have to do a lot of the same calculations to figure out if you fall into one of these 3 eligibility requirements, but you don't have to run through the full math and calculations on the application itself. So if you do fall into one of these, then yeah, you're in a good place because you get a little bit of an easier road. So the last 2 slides is just going to go over some common mistakes to avoid while you're filling out the application, and just some hiccups along the way that we've seen. I think one thing to stress is that the SBA did release a memorandum to lenders saying that, especially in smaller things like this, like you don't get your application rejected just because you made some small mistake, but lenders generally will work with borrowers. So, the first one is the box that makes you fill out your covered period. I think a lot of people think that the covered period is just up until the date you apply, but that covered period is still the full 24 weeks. So when SBA said you can apply early, it still said those electing a 24-week covered period may still apply before the end of the covered period, but doesn't shorten your covered period. So it's a little bit odd because there isn't really a place on the application where you get to say, oh, I only actually went for 10 weeks. So that's kind of one thing to keep in mind. But if you do mess this one up, I don't think you're going to have your application tossed out. But I think that's one question that's come up. Another one is about the payroll and non-payroll costs that you put in. This is especially important for people who do have an FTE reduction calculation, because if you end up putting way more payroll costs in this box than your loan amount, that reduction calculation is going to get a little bit, the math is just going to get a little bit off. So the CARES Act defined payroll costs as the amount of the loan that is spent on payroll and then the amount of the loan that's spent on non-payroll. So when you're filling out the payroll and non-payroll cost boxes, those amounts really shouldn't exceed the loan amount, because you can't, you didn't spend your loan amount on it. So if you have $1 million loan and you put down $2 million in payroll costs, then clearly you didn't actually spend $1 million, unless somehow that was very ingenious of you, but that amount shouldn't exceed it. And if you don't have an FTE reduction, this won't cause you any problems. But if you do have to go through the calculations, you're going to have some kind of wonky numbers if you end up putting down a lot more than it asks for. And I mean, it is definitely confusing because it doesn't actually say that. It just says, what are your payroll costs over 24 weeks? So I think that's something that's coming up. But once you run through the numbers, you realize why that's important. So the other kind of tricky spot is to figure out the forgiveness amount. And so the total forgiveness is going to be the lesser of total expenses minus salary and wage reductions times the FTE reduction quotient, or the total PPP loan, or payroll costs divided by 0.6. So those are the three different ones to keep in mind. So our very final slide just kind of runs through it, and you can kind of go over this on your own, but it gives that example of, again, a borrower with a $100,000 loan and really trying to figure out which one of these is the lesser of. So each different box, the first one takes into account the reduction quotient, the second one's your loan amount, and the final one takes it into account the payroll costs. So those are the three calculations you go through, and whichever one ends up with the lower number, that's going to be your total forgiveness amount. So that's all I have. I don't know, Andy, if you had anything else you wanted to jump in on before we turn it back over to our colleagues.
No, well done.
Very much. Really appreciate it, Llewellyn. That covers a lot of the really important changes. We're going to turn it over to Mr. Neal to discuss SBA audits and looking forward down the road at what's next for the PPP loans. Mr. Neal.
Good afternoon, all. We're in a position now where I assume that a lot of you are gearing up to submit your forgiveness applications, or maybe you already have in the recent days. And what we have hanging over nearly every borrower is, what about those SBA audits that I keep hearing about? What are those going to entail? How is that going to impact me? So we want to give a quick update on what we know so far and what we're still waiting for. And we all expect here on the panel that the SBA any day now is going to come out with additional guidance that may change some of these points. So it's important to try and stay up to date on these changes, because they may have a pretty drastic impact on how they may impact you. So at this point, we know that there will be an automatic audit of loans that are $2 million or more. We know that even if you're under $2 million, the SBA has said that it has at its discretion the right to review any other loan. That review, both the automatic review as well as the discretionary review, we know that the SBA may and likely will evaluate not only, you know, how you spent the loan, but they're going to look at whether you were eligible for the loan. And the key parts of the eligibility analysis, is you're probably well aware and having, you know, flashbacks to a few months ago, is did you meet the size threshold? Did you conduct the, you know, affiliation analysis to see how big you were when aggregating, you know, your head count with those of your affiliate companies? That will be likely a big part of what the SBA is looking at. And that's been one of the major areas of uncertainty and sort of a desire for clarity among the borrowing community as well as lenders of how is the SBA going to apply these, you know, fairly ambiguous rules. The affiliation rules, you know, are part one of that, you know, eligibility analysis. The second is this certification that the loan was necessary, which is a term straight from the CARES Act that the SBA, you know, continued to use in all of its rules, but there's been a lot of confusion and uncertainty after the SBA in late April sort of threw a wrench in most borrowers' understanding of what the certification of need requirement really meant. So you've got eligibility on the front end that they'll review. Then you've got, you know, how you spent the money and activities after your loan was dispersed. So you know, the SBA will review, you know, the documents that you submitted to your lender, the other documents that you are required to keep but maybe did not have to submit to the lender, you know, your calculations for loan forgiveness, as well as, you know, compliance with the loan terms. There are a number of, you know, terms that hopefully all of you have read in your loan documents that could have a big impact on borrowers and, you know, eligibility for forgiveness. So what we don't know, how the SBA is going to conduct these audits. We're talking about 20,000 plus audits, and how the SBA is going to do that and when they're going to do that is still up in the air. Treasury Secretary Mnuchin commented during a congressional hearing a few months ago. He sort of slipped in there, you know, and we're looking to see, you know, if that can be automated, at least in some way. So you know, we suspect that they're going to try and automate a big part of that process for a number of borrowers, because it doesn't seem that the SBA will have, you know, the person power to review that many loans. And we don't necessarily know when those audits are going to occur either. And that is a big sort of cloud hanging over a lot of folks, and we'll get into that in the mergers and acquisitions context. But when that audit is going to occur, we know that borrowers are required to maintain documents associated with the loan for years after the loan was dispersed and forgiveness even, you know, achieved. But so there's this durational timing, there's this timing issue that we're waiting on clarity from the SBA. So in the next slide, we'll just get into a little more detail on, you know, the first likely focus of the audits, which is eligibility. We're not going to go into this, rehash this, but, you know, you got to meet the size standard, and there are three options: 500 or fewer, your NAICS code, which is employee headcount or revenue based, or this alternative size standard, which is $15 million of tangible net worth and $5 million in average net income. And keep in mind that, you know, underlying all that is, you know, the affiliation analysis is that you're as big as your affiliates, unless you met one of those waivers in the CARES Act. Affiliation, ownership, this present effect rule, which is an issue that we'll talk about a little bit in the M&A context. But, you know, what happens if you enter into a sale agreement and you sell the company? How is that going to impact your eligibility for the loan? And that's something that the SBA will likely look into. We're still sort of waiting for more guidance from the SBA on that. Then you've got common management, and this identity of interest where, there's a rebuttable presumption that, you're affiliated with companies controlled by, your close family members. They'll also likely look at your type of business and whether you are an eligible business or an ineligible business. A couple of the main categories there: private equity firms themselves and investment banks have been deemed ineligible for these loans. There are a number of other types of businesses that are listed as ineligible businesses, and so those will be part of the review. Some common areas of confusion that we've seen out in the market is where borrowers themselves were not restaurants, NAICS Code 72, or franchises, or receive financial assistance to qualify for the waiver of the affiliation rules, but their affiliates were, and that waiver applies only to the borrower. So if you are not you don't fall into one of those categories, you don't get to cut off your affiliation link to those affiliates that may be able to do that for themselves. That's a common sort of issue that we're seeing out there. As well as, when calculating your size, you got to look to all your affiliates, not just those that have sought PPP loans. Next slide, area number 2 is your certification of need. That is something that the CARES Act really changed the SBA's normal evaluation of whether you are eligible for the loan. The CARES Act says you make a good faith certification that the loan is necessary to maintain ongoing operations. That's a pretty darn subjective test that many, if not most, borrowers should meet. The SBA, after a lot of sort of public outcry, if you remember back to Shake Shack and Potbelly, that they said, oh no, if you got access to liquidity, or if you're a public company, you are not going to meet this test. But that was just in an FAQ. It has not been incorporated into a rule. The CARES Act and the PPP program rules, there's no revenue test. There's no requirement that you have lost money. So that is something we don't know, though, how the SBA is going to actually evaluate how borrowers are, going to satisfy that test. What we do know is, what's in the statute, as well as some of the sort of legislative history going into that. And at this point, we're waiting for more SBA guidance on how they're going to evaluate that loan. But it seems pretty clear that the FAQ 31, which threw in that thought about liquidity, that is not actually binding at this point, and we're still waiting to see how the SBA is going to look at that. Next slide. The final area of forgiveness, or final area that the audit will likely focus on, is how you use the loan. You're seeing out there criminal charges being brought about against borrowers who got PPP loans using fictitious employees, and they bought Lamborghinis. Those are your obvious targets as to how you did what you weren't supposed to do with this program. But the SBA is going to look at how you spent the loan, all the documents that you had, your calculations, where we are waiting and expecting guidance is what the SBA is going to look at and how deep they're going to look as to your business activity after application and loan disbursement, up to forgiveness, or even after forgiveness. You've got your pot of money that's PPP money. You used it for the payroll allowable uses, but then you still conducted your business with other pots of money. It's unclear as to whether that's going to be part of their analysis of how you used the money. And the other big issue we're seeing in the market is how they're going to treat mergers and acquisitions. PPP borrower gets a loan, uses the loan, and then applies for forgiveness, but then gets acquired by another company. How the SBA is going to look at that? I mean, it's completely clear that the borrower will need to get consent from its lender to that proposed transaction in most instances. But beyond that, it's we're waiting to see, and lenders are really waiting to see right now how the SBA is going to treat borrowers that got a loan, used the loan, and subsequently were acquired or entered into an agreement with another entity that changes the ownership or control or the size of the business and its affiliates. Next slide. So preparing for an audit, what you can do now to get ready. Compile all the needed documents that you have for your forgiveness applications, as well as other supporting documents. If you didn't do it at the time of application, we recommend that you do it now, and that is write up a narrative as to how you were eligible, why you needed the loan. Couple factors here that you should look at, but we recommend working with your counsel, working with your accountant to click off all the boxes here so that you're prepared in the event of an eventual audit. So that's all I have on this, and I'll turn it over to Andrew.
Well, briefly, just before we jump into that, Sam, as a follow-up, just spend a minute on this. The SBA did issue, in fact, on Monday, the guidance regarding the appeal process regarding negative determinations regarding SBA PPP loans. They've outlined the 4 characteristics in an interim final rule that modifies Part 134 of Title 13 of the Code of Federal Regulations, which is the existing Office of Hearing and Appeals regulatory guidance regarding the ordinary appellate process. There are some modifications there. Key things to keep in mind with regard to that. We don't have a lot of time, and I don't have a slide on this, but I want to briefly touch on this very new piece of guidance. One, it does outline the 4 specific types of decisions that are appealable, outlines the process by which it's done. Most importantly, allows for timelines. Key things to keep in mind. One, you have 30 days to file. So as Sam mentioned, be prepared. You don't have a lot of time to submit information. And just as importantly, it appears you get one bite at the apple. There is a single brief submitted in support. The SBA will prepare a response and administrative record, and you get no reply. The decision is made on the basis of the materials that are submitted by the SBA and your initial petition for appeal. So again, as Sam mentioned, you don't have a lot of time. Make sure to have your records ready. Be prepared in case a negative decision does come in. You'll have to respond quite quickly. Sorry I've been interrupting there. I'm going to turn it back over to Mr. Diazis to talk about tax considerations and PPP loan insurance.
Thanks, James. As we're running over a little bit, I'll try to be brief and really focus on the high-level issues here. There are really 2 tax issues really we want to focus on. The one is that while you have forgiveness of the PPP loan not being taxable income, when that happens, hopefully later this year or next year, the IRS is going to take the position that any expenses that are paid or incurred that allow or facilitate the forgiveness are going to be non-deductible. And that's a very unfortunate thing, because really what it does is it makes this really neutral for tax purposes. And so a couple things to really think about. One is, do you want to challenge that position? If you don't want to challenge that position, then to what degree do you need to really increase your estimated tax payments to account for that loss of the deduction that you might have been counting on, especially if you're using the current year method. A lot of employers are waiting patiently for a technical correction to this. There's been a lot of resistance to this. There was a letter actually to to the House and the Senate leads. And, you know, we're just going to have to wait and see how that's going to play out. In the limited time we have, I wanted just to check with Andy to see some of the tax planning that's being done, because there are some alternatives other than sort of the all or nothing position in terms of challenging that.
Yeah, thanks, Andrew. So yeah, a couple of items. The timing. So if we had actually a client who was a June 30 year end and they had spent all the money, can they take the deduction on their June 30 tax return, which is coming up? Well, they have time to do it, but they can file. And what do they do? Now, we battled this around within our firm, and we think that they can take the deduction. The question is, what happens when they get the loan forgiven? And you know, think that the right answer is you just make a 481 adjustment and spread it over 4 years potentially, or you effectively include an income that way. The importance of that is that if you're creating an NOL, because if you're in an L situation, this adds to the NOL, they can get carried back to an early year where the rates were higher. That's where that becomes important. So, you know, in terms of not agreeing with the notice, the IRS notice, we're a little, it is authority at some level. So we're a little channel, but in terms of taking a deduction and dealing with it when the loan is finally forgiven, we got comfortable that that is a valid position. The other thing is around there is some proposal, or at least discussion about maybe not allowing payroll costs to be deductible, but the other expenses to be deductible. We'll have to wait and see how that plays out. But when you submit your information, you can in theory submit, if you're on the 24 weeks, you could submit enough payroll to cover all your loan amount and get the forgiveness, right? But that might be evidence that, okay, and all that was forgiven was the payroll, not the rent and utilities, which may be deductible. So you may want to make sure you have that information and submit it, even if you're okay just with the payroll. So
that makes a lot of sense. You know, it's really kind of striking that the IRS is really saying in that notice that, gee, we're looking at what was expected to be the forgiveness. And the idea that, like, you can't deduct in the current year when you don't really know if you're going to get forgiveness is really fairly aggressive. I mean, if you think about what happens in the bankruptcy context and forgiveness that happens there, they don't force the party to go back and amend returns and say, oh, those deductions you took originally, they're no good. So we'll wait to see how that plays out. Second thing I wanted to just touch base on is this whole question of how the employee retention tax credit and PPP loans work. So not only do we have questions in mergers about how that transaction will affect the ultimate loan, many times the buyer won't have PPP loans, the target will. Now what happens when there's an acquisition, because there's a taint rule, so that basically if any company within your control group has a PPP loan, you are not supposed to get the employee retention tax credit. So the question is, does that apply on a retroactive basis? Does it only apply on a prospective basis? Would you look at this so that really there were sort of two separate control groups? It's really unclear, and the time to address that is very early in the transaction and not on the eve of closing, which has happened on more than a few occasions recently over the last few weeks. And if there is a choice in terms of transaction form, some people have been looking at potentially asset sales with leaving the loan behind. So the idea would be that the loan never really becomes part of the control group. Whether that will work or not is remains to be seen. One could see maybe the service saying there's a successor, but certainly on the form of it, an asset sale, all of things being equal, makes that look a little bit better. And then there's both on the House and the Senate side, there's proposed legislation to basically allow for an employer to take a tax credit for employee retention, so long as the dollars aren't also being used to increase forgiveness. So if the wages you're paying are not creating forgiveness, then you should be able to get ERTC under this proposed legislation, but who knows what's going to happen with that. Next slide, please. Okay, PPP loan insurance, next slide. I'm just going to talk about a couple things. the market has sort of responded to what's happening in terms of insurance products being now available for PPP loans. And basically, there are only a few of these products, but basically what they do is they will generate funds for the insured to repay amounts back to the government if there's a determination that the business shouldn't have gotten the loan. So why would you want this? Well, as I think you probably have gathered through this presentation, there's certainly a lack of clarity in terms of the number of eligibility rules. In some cases, you're going to have employers that are going to be concerned about certification, in other cases concerned about affiliations, and this audit period lasts for 6 years. So that's a long time to have a cloud over your head potentially on this. And we've taken a look at a number of D&O coverages, and in most cases, they're not going to apply. The main thing to know about these arrangements, at least the ones we've seen, there are only a few insurers that are doing it. They really will cover eligibility and not the loan forgiveness. The loan forgiveness element is really something that you have to take the risk on individually. And then you need to closely take a look at what costs are covered. And it's not going to be, if there are any penalties and like, it's not really likely that those are going to be covered. It's really just the loan repayment. And then after the SBA has an adverse determination, defense costs. And so who might look at doing this? If you've got a company that's more than $2 million of a PPP loan, which means that they're going to be audited, that's a candidate to the extent they have certification or affiliation concerns. And then also in target companies in an M&A transaction might want to look at that. Certainly, there are a lot of concerns with representations and how long they last. And so insurance could be a good alternative in that circumstance. I'll tell you from having gone through this, don't think it's going to take, a week and you talk to your broker and you pick up the phone and you get the policy. There's a fair amount of underwriting that's involved with this. They're going to want to see your documentation. There are going to be special questions you have to ask. And so, rather, they're going to need to be answered. And so, you probably should build in about a month to really get one of these policies if you're interested in it. I know James has worked on quite a few of these. I don't know if you have any final comments.
And in fact, and Andrew, just to overlay on top of that, one of the interesting developments is actually utilizing that underwriting process from a buyer perspective of an acquirer of a PPP loan to essentially have a third-party review of the loan's adequacy as well. So give kind of another an independent view is another strategy that we're seeing now, taking advantage of the insurance product itself.
All right.
I think Mr. Lee has us here on mute. Sorry about that.
I'm sorry.
No, go ahead, please.
I was just going to say we're going to pass the baton back to Sam for a minute or two here for a quick legislative update, and I think we're going to wrap up.
Thank you, Sam.
Thanks. And I don't think we even need a minute because unfortunately you all probably are seeing the news. Congress isn't doing anything right now. There are a number of proposals on the table. We hope that at some point there will be agreement. There's some proposals that could be good for a number of you out there, a number of borrowers. But right now there has not been a meeting of the minds, and it doesn't look like anything's going to happen in the next few weeks. So that being said, we have seen, and the last time we did this webinar was on May 22nd. That night, the SBA came out with new rules and guidance that had a pretty big impact on borrowers in the process. So even absent legislative action on the PPP program, we fully expect there to be more SBA guidance and rules to come out, even more so in the absence of legislation. But that being said, I think maybe James, you want to take a couple questions or maybe a minute or two more. Sorry for running long.
No, I thank you. I think we're now 15 minutes over. I think we're going to have to wrap this up pretty quickly right now. I thank you all for attending. I really appreciate all of the submission and questions. Please continue to submit them our way, and we'll continue to try and respond to them. Unfortunately, based on the time limitation, we won't have time on today's call. thank you very much again for joining us. On behalf of the entire loan assistance team, thank you for attending. Have a great week.